Hey, welcome back, everybody. We're looking forward to this week. We're going to get 4 of the Magnificent Seven companies to report, and also we're going to hear from our federal chairman, Kevin Warsh, this week about their rate policy. So we might see a rate cut. Most likely it's going to stay put, is what we're expecting and hoping for. We're going to really dig into some underlying numbers of what's going on in the marketplace. We're going to talk about opportunities and challenges that are in front of us and how it might affect your portfolio. So stay tuned. Hi, I'm Adam Anderson, owner and founder of WealthGuard Advisors.
Hello, I'm Blake Anderson, certified financial planner. Thanks so much for joining us.
Yes, thank you for being with us. So we are about a third of the way, not quite a third of the way through earnings season. We've had about almost 30% of the companies report, and actually the majority of them are coming in with higher than expected earnings. We're seeing productivity still being a leading thing. My underlying thesis is that as they adopt artificial intelligence throughout the industries, they're becoming more efficient. So we talked about Adam Smith and the Wealth of Nations, and the Wealth of Nations is in the productivity of its people, and they are becoming more productivity. So more wealth creation. So I like that.
Yeah, we are seeing pretty good numbers on earnings overall. Very strong earnings season. You might be wondering, well, why isn't the market up then? And I think that's because we had become very concentrated in a few select tech names, and we're still seeing that rotation out. So that's why this Microsoft, Meta, these earnings will give us a little more insight into these companies. We'll see the effect that these massive CapEx expenditures are having on them. But just in general, the trend of moving away from these mega cap tech and computer chip stocks towards the broader market is happening. We highlighted this with financials a couple weeks ago and saw that their financials were very strong last week. And then this week, I'm looking at a few healthcare names. It also seems to be capitalizing on this transition away from the mega cap growth tech names towards more value oriented, dividend paying, broader base market growth.
Yeah, let's put some charts to this to give you kind of an idea what we're looking at. So I have the S&P 500 over here, and as we talked about, we had such a big run out of the kind of the Iran conflict, hopefully becoming resolved. Now we got that kind of back on the table again. But really, since mid-June till now, it's been pretty flat. And really, this is kind of a consolidation, and it's what I consider healthy for the market. We had a nice big run out. We're basically flagging, as I usually say. We're flagging sideways, and that's just kind of digesting the market. Now, there's a lot of underlying theses going around there. Of course, China coming out with competitive AI services has spooked the market. Definitely taken a little bit of the wind out of the sails are tech companies. But let's look at it a little deeper. A lot of times, like Blake was just talking about, we're talking about growth versus value. We talk about financials, health insurance, and that would be the SPYD. That's the more dividend-oriented companies that are reinvesting their dividends. And look at this here. Coming out of that May low, we've been very consistently upward on this. So 11.5% over that period of time. But other than this little divot there. And then let's look at the growth, which is going to focus on a lot of those growth company names, the tech companies out there, where we saw a big run up in the beginning. We are still, like I was talking about, kind of digesting those gains, going right down to there. So that's 20%. So interesting. We have more volatility on the growth sector, but we have a greater gain, almost twice, from 11 to 20. So maybe not as a comfortable of a ride, but a more rewarding one. We still like the dividend side right now. We're focusing on financials like Blake talked about. We're looking at healthcare and focus on that. Let me just give you a couple charts on that. XLF is our financials. Boom. Looking good. I can't catch it. There we go. Again, coming from that March low, about 17% on the financials, close to that. And then there's the general health care. Well, we'll take it from that same period of time, even though it went lower than that. and then higher. And that's about 14% on that.
Yeah, I think it's just something to watch as we continue. If you're comfortable with the volatility, I don't think these, growth names, these tech names need to be, wholly divested from. I think they still have room to run. And you just have to wait out periods of volatility like this, where we get some consolidation, where we get a little bit of a correction, which is healthy. But in the meanwhile, if you have some money on the side, I wouldn't be sitting out of the market. I would be looking at these more dividend names and saying, hey, I could get in on these companies that aren't as run up as, the tech side of the market and collect pretty good dividends on a lot of these companies' names. 1, 2, 3% dividends in addition to the modest growth that we're seeing in them right now.
Yeah. So one of the things that Blake and I were discussing and looking at earlier is that the average PE of the market is actually higher than normal. And I think normal, correct me if I'm wrong, Blake, was around 16 something percent is the PE ratio. We're in the 21% range on average. So meaning that the average companies are kind of highly valued compared to their historical averages. Going back to productivity, we seem to have a productivity spike at this point, so maybe it justifies that. But so we're not saying get out of the stocks. We're maybe saying rebalance towards things that are more, diversified. Diversification brings protection to your portfolio. So as we take profit off of some of these big high flyers we've had, move it more towards our a diversified portfolio, part of the side of the portfolio. So we talk a little bit about balancing diversification and concentration, where we kind of protect things by being diversified and have opportunities for growth by being concentrated.
One other thing I think is important to note is the Federal Reserve. They have their meeting this week, their decision this week. This will be the second one. Most likely, we're going to hold again. There is a not insignificant risk that they'll actually raise rates this time. I was looking at the new betting market odds on it. It was about 25% odds of a hike there. So not super likely, but it's a possibility. And if we did start seeing hikes, or if we saw, Kevin Warsh has been a little more cagey, a little more reserved in the amount of communication he gives and the amount of sort of lead that we grew accustomed to under Powell. He's being more restrictive, more keeping cards close to the chest. So if he does say something about, we're looking at rate hikes or something to suggest that path in the future, that might weigh on the markets a little bit. So something to watch on Wednesday.
Yeah. So I'm sure that the market's kind of on hold, waiting to see what they're going to get from the Fed. And that will kind of maybe mute some of the performance this week as people are kind of, sitting on their hands, so to speak, waiting for that to happen. So these are just the companies that are coming out this coming week. And there are some big ones on the docket for us to watch to see what's going to be happening out there. Boeing, Coca-Cola, Visa, Ford, SoFi, Meta, Robinhood, ARM, which we have a lot of people in ARM, Lam Research, Procter & Gamble. This is kind of a dividend player. We have a lot of people in that. Humana, talking about Blake's their thesis on healthcare. Cigna also. We got Amazon. Also, we got a lot of holders of that in our portfolio. Some of the big oils are out. ExxonMobil, Chevron. Look at this, Altria. I saw a report on this. In the last century, what the best performing stock is over the last 100 years? Philip Morris. You know who Philip Morris rebranded as? Altria. Have a 5+% dividend. Obviously, we don't own a lot of that for our clients, just on moral issues there. So anyways, we have some big names coming out this coming week, and we're looking forward to getting a little bit more insight on the direction of this market. So I want to talk about, we are doing a retirement readiness seminar in Dublin, down in the Bay Area. It's going to be August 6th at 6:30 at the Dublin Civic Center. So we're doing this in conjunction with our friend Sandra Stefano, who does Medicare, and there's a lot of people already went to her Medicare classes, and they're when I do a more retirement readiness where we'll go over Social Security planning, leveraging your tax advantaged investments like Roths and Roth conversions and IRAs and 401ks, and a lot of other things that are really important as you get ready for retirement, how to best structure yourself and how your investments should, be strategized in order to make the most of your retirement. Talk about income planning and all those kind of fun things, diversification.
Yeah, we look forward to seeing anyone who can make it to that meeting. We also are planning more in the future at other cities in the area. So if that's something that interests you, let us know, and we'll get you the information. Reminder here at WealthGuard Advisors, we are a registered investment advisory firm registered directly with the Securities Exchange Commission. And part of this is a fiduciary responsibility for our clients. We're obligated to act in their best interest. So that's something that interests you, would work for you. We'd love to talk to see if we could be a fit for your financial picture right now and helps you steward your money into retirement and beyond. Thanks so much for listening. We'll see you next time.
Yes, thank you so much. Have a great week. We love you.